Everyone online talks about passive income like it's a magic ATM. You wake up, check your phone, and money has simply appeared in your account. The reality is that true passive income is just delayed compensation. Every single stream that actually pays out requires a heavy upfront investment, either your time, your money, or both, before it generates a single dollar. Think of it exactly like a vending machine. There is a grueling active phase where you actually have to buy it, stock the inventory, and negotiate the placement. The passive phase only happens after that system is fully running. It makes money while you sleep, but you still have to own and maintain the machine. Because most streams require at least 90 days of work before yielding a trickle of income, month 2 is the critical breaking point. That is the moment when the initial excitement fades, the results are still zero, and the majority of people quit. To build a successful stream, you have to decide what you are going to invest. You are either deploying cash you already have, or you are deploying upfront labor. If you select a strategy that requires 10 hours a week, but you're working 60 hours at your day job, you will burn out. You have to match the vehicle to the resource you actually have right now. This decision tree maps out the 2 potential paths. If you fit into the surplus capital branch, you need low-friction, mathematically predictable returns. You want strategies that don't require daily attention, like high-yield savings accounts and dividend stocks. Honestly, auditing whether you have more time or more money is the mandatory first step. It dictates every single move you make next. If you have surplus cash, your baseline defensive layer should be high-yield savings accounts and money market funds. Parking $10,000 in liquid cash in a high-yield account earns roughly 5% APY. That is $500 a year for letting money sit. Over time, this protects wealth against inflation with virtually no risk, but lacks the growth needed to build independent wealth. To get that higher growth, capital-rich individuals need to step up to dividend stocks and exchange-traded funds. This means accepting stock market exposure in exchange for companies paying you a percentage of their quarterly profits. The real momentum comes from dividend reinvestment plans, or DRIP. By automatically buying more shares with your dividend payouts, the math scales. As we see here, consistently investing $500 a month at an average 7% return crosses $86,000 over 10 years. But this track has its own costs. Tying up your liquidity for years, weathering wild market volatility, and waiting with massive patience before dividends can replace your salary. The capital-heavy track relies entirely on patience and mathematical compounding. You are successfully substituting active labor with financial leverage. If you don't have thousands to invest, you fall into the surplus time category. You replace financial investment with massive upfront labor, sweat equity. The first highly scalable option here is digital products. These are Notion templates, budgeting spreadsheets, or mini courses that you build once and can sell indefinitely. The input required is intense. You will spend hundreds of completely uncompensated hours researching niche markets and designing a high-utility asset from scratch. Once the product is finished, the financial profile is exceptional. You have infinite scalability, zero shipping or inventory constraints, and near 100% profit margins. The trade-off is extreme market competition. Creating the product is only half the battle. You face relentless, ongoing marketing labor just to stand out and find buyers on platforms like Gumroad or Etsy. Digital products offer massive asymmetric upside, but only if you have the stamina to bridge the gap between initial creation and continuous distribution. If you are willing to play the longest game possible with your time, search-based content, specifically YouTube and affiliate marketing, serves as the primary long-tail revenue driver for time-rich creators. Building a content library requires grueling upfront labor. You commit to consistent scripting, filming, and optimization over a multi-month period before seeing traction. The financial reward comes first through YouTube AdSense. Finance and education niches are highly lucrative, with advertisers paying high rates, often $8 to $25 per thousand views. You can then multiply that base revenue by embedding high-intent affiliate links. A viewer searching for the best budgeting app is ready to buy, and a well-placed link captures a commission on that traffic for years. Look at the trade-off. During the active phase, you are working intensely, and the income line stays completely flat at zero. This algorithmic dependence takes a heavy psychological toll. As effort spikes, the risk of creator burnout during this unpaid phase is extremely high. Search-based content yields the highest passive return over a multi-year timeline, but only for creators who survive the grueling, unpaid active phase. Regardless of which time-heavy track you choose, you need to understand the actual chronological timeline required to stabilize these streams. Months 1 through 3 are strictly for building, with zero expected income. By months 4 through 6, if you are consistent, you might see small trickles of $50 to $200 a month. As your library of content grows and your dividends reinvest, you eventually reach a crossover point in years 2 or 3 where the volume of passive output finally exceeds the active effort required to maintain the system. And the wealthiest creators don't rely on a single home run source to get there. They use a stacking strategy. They build multiple small, diverse streams. $300 from dividends, $500 from a digital product, and $700 from YouTube. Alone, they are small. Stacked vertically, they aggregate into a robust $1,500 monthly cash flow. This diversification acts as a safeguard. By stacking multiple small streams, you ensure that the failure of any single asset won't destabilize your entire monthly cash flow. Let's map your final decision. If you are cash-rich and time-poor, avoid the trap of labor-intensive side hustles. Your path is to aggressively scale your inputs into high-yield savings accounts and dividend ETFs. If you are time-rich and cash-poor, ignore the tiny dividend yields you'd get on a small portfolio. Your path is to fully deploy your sweat equity into building scalable digital assets. Whatever you do, avoid shiny object syndrome. Spreading your resources too thin by attempting to build 3 different streams simultaneously from day one is a recipe for failing at all of them. Pick exactly one path today based on your honest resource audit. Commit 30 minutes to researching just that one strategy. The next 90 days are going to pass no matter what. The only variable is whether you spend them enduring the active phase to actually build an asset or just consuming more content about it.